Hey, what's up, everyone? Welcome back to Pave the Way podcast. I'm your host, Greg Helbeck, and today I have Michael Zuber from the Bay Area of California on the show. And today we're going to talk about a lot of good things. We're going to focus a lot about rental properties. So, Michael, thank you so much for coming on the show today.
Thanks, Greg. This is been looking forward to this for several weeks now.
Awesome. Well, same here. I saw it coming closer in my calendar, so I'm very excited to have you on now. So, Michael, this is the first time I've actually spoken to you really, I guess, in person, even though we're on a web conference here. So I'd love to know a little bit about your background and kind of how you got into all this stuff.
Yeah, so I guess my story with rental properties begins on my 30th birthday, which, if you're doing math, was 16 years ago. I self-evaluate every year on my birthday, kind of where I'm at. I've done that since I was in college. And, my 30th birthday didn't start so well, right? I had made decent money doing what you're supposed to do, right? Go to school, get a good education, get a good job, climb the corporate ladder. But on my 30th birthday, I had nothing to show for it. I had a couple of good stories, a couple of silly toys. But I had just read Rich Dad, Poor Dad, and had realized I was in a rat race and just running faster and faster. And I was very disappointed to learn that for lots of reasons. The most one is because through no fault of my parents, they told me that was what I was supposed to do, right? Nobody in my entire family has a college education, let alone a master's degree. I mean, both sides, mom, dad, aunts, uncles, cousins, niece, nobody. So I thought this was the way out, right? And I got to 30, read that book cover to cover 5 times in a row. And I was like, oh my God, wrong answer. So the book, the big takeaway for me, the book was cash flow and rentals were the way to go. So I started, sacrificing, living below my means and all of that, so you earn, save, invest. And we bought our first rental. Like you said in the intro, I live in the Bay Area, which means I didn't buy the rental in the Bay Area because they just don't make sense. So I chose a market 2.5 hours away in Fresno, California. And we bought our first rental house on Norris Drive for $107,000 that rented for $1,100. And wow. That was the beginning.
Good.
Yeah.
That's awesome. Okay. Yeah. So you got started. And it's funny, a lot of people, I was talking to one of my friends the other day and we were chatting and she was telling me, she was like, she's super ambitious. And, I told her, I said, I want to give you this book, Rich Dad, Poor Dad, because I think you're going to be, this will flip a switch in your brain. Right. And it's really going to get you to think a little bit different about just everything, money and personal finances. And it's funny. I told her, I said, listen, a lot of people that I'm friends with, or a lot of successful real estate investors, they say they got started with Rich Dad, Poor Dad. So
yeah,
I just think it stands the test of time, that book. I remember reading it back when I got started, and it's a paradigm shifting book. It just makes you think about everything so much differently.
Yeah. I've met both sides. So first off, it's crazy that book is still relevant 20 years later, because it's 20 years now it's been out and it's still relevant today. But I've given it to people, and some people love it and they see the switch. Others are like, well, that book's horribly written. I mean, his grammar is terrible. And I'm like, well, this is not one of those books, no. Right? It's not an eloquent story.
Not at all.
You either get it or you don't. And for me, it was literally felt like a gut punch. I was just left knowing I wasted my 20s. And, that's a bad feeling, right? I wasted my 20s and I was starting at 30. But the good news is you can start at any age and started at 30, was done at 45. So all because of rentals. Never did wholesale, never did flips. I couldn't. I had a crazy busy day job. So, rentals can work if you're willing to commit and think long term.
Absolutely. And that's exactly where I wanted to take this conversation. So you had a great job. You're in the Bay Area, a lot of great, opportunities there for good corporate jobs. So the thing is, with a lot of people a lot of my good friends, they're big time flippers. They buy and sell. I do a lot of that too right now.
Yeah.
And the funny thing with Rich Dad, Poor Dad is, before we start to get into the whole rental part of today's conversation, is that the book never really talks about flipping properties or wholesaling. It talks about cash flow, buy assets, and the assets pay for your liabilities. So everybody gets into this business, and I think they get kind of in this almost, I wouldn't say it's a rat race, but they get in this deal to deal to deal, kind of situation where they don't have their job anymore. They own their company, but now they're just doing transaction after transaction. And if the marketing stops, or if they don't want to be a flipper anymore, well, now their income is evaporating.
Yeah, I would tell you that is the rat race. It may not be classically defined. You may be able to call yourself the CEO or the owner or the chairman or whatever the freaking fancy title you want, but you have nothing more than a job that owns you. Um, that's not what I took from the Rich Dad Poor Dad, right? You need to have
Yes.
assets that pay for itself, that send you these little mailbox money every month. And it starts with a trickle, man. It starts slow. But it builds over time, and the trickle becomes a small stream, and then the stream becomes something bigger and bigger. And I promise you, it works. I mean,
That's awesome.
I had questions 8 years in, but my
Sure.
wife retired about year 12, and I retired at year 15. So
That's amazing.
it can work.
Absolutely. So let's kind of fast forward before we get into the nuts and bolts of rentals. Now,
Sure.
what does your rental portfolio look like today? Because you've been doing this for a while now.
Yeah, we have. Well, so I don't. When I get that question, I usually answer. We have 175 rental units, or I call them doors. It's a mix between single family up through 18 unit apartment buildings.
Okay.
So we did some 1031s. We bought a lot of stuff during the crash, but we're buy and hold. We didn't sell anything. We sold a couple of things after we exited just to reposition debt. But as we were acquiring, we never sold. And the other thing is we own this, and our LLCs. We're not syndicators. We're not borrowing other people's money to, these are ours, right? It's not, we don't get like 1/4 of it. Like some people talk about, oh, I've got 2,000 units. Well, yeah, you're 1/100th of a limited partnership or something.
Yeah, exactly. Yeah.
This is ours, 175 units, over $1 million in gross rent a year. So it's a decent portfolio.
Yeah, no, that's awesome. And I'm glad you kind of brought that up because I see that a lot. And as I kind of looked more into cash flowing ventures, syndication is great and it's a great way to scale. But a lot of the times when you say you own a lot of these units, you really own a fraction of the equity, right? And then you also have the bank loan behind that. So if you really think about how much you're taking home, if you own a lot of these rental properties, as like you said, as the principal owner without limited partners, you're a lot more wealthier than the other guy, and you might have less units, but you own more of the pie,
No question. And I'm truthfully glad we did it that way. My whole life has been about sacrifice and living below our means after my 30th birthday. And I was comfortable going at the pace that we could. I didn't need to lie to myself. I frankly didn't want to add complications to my life. I already had a crazy work-life balance. And the last thing I wanted to do is have limited or even general partners that I felt like I had to report to and do extra work for. And no thanks. I don't want that headache. I don't even want that headache now, and I don't even have a job. I'm happy adding a couple more units here and there, and just being fine. Even though I could do bigger and better, I don't want complications at this point in my life.
Absolutely, man. There's nothing wrong with that. You got true freedom at its finest, man. You got the true mailbox money. So you have a mix of single families all the way up to, you said 18 unit. Those are technically commercial, but they're small.
Oh yeah.
So
yeah, definitely. Yeah, we have probably more, if by unit count, more than half our units are technically commercial, which is 5 and above.
5 and above. Okay. So let's kind of start with the single family thing first, because I want to let you know, and I think a lot of listeners are probably very excited I brought you on the show, because I have a lot of flippers. I have a lot of people who maybe they're at their job, they're younger, they're my age, or they're older, and they're just trying to get that freedom that they're looking at, a financial freedom. Mm-hmm. Rentals are the way to do it, right?
Yep.
So let's go back to your the first the single family stuff. So I want to talk about something that a lot, how you kind of did it, and then what your thought processes are on a certain strategy that I like. I'm sure you're familiar with. It's called the BRRRR strategy, where you buy a property at a wholesale price, you close on it, you add the value, then you get it reappraised, and then you refinance basically all of your capital back out of that property. Mm-hmm. And then you take that capital and you can just do it again. So were you doing that when you started, or were you kind of putting the loan down, getting 20%, and then scaling that way? So how did you scale? Because a lot of people, they have issues scaling.
Yeah. So we'll answer that in kind of 2 different steps.
Sure.
So the quick answer is I didn't know any different when I started. So that first house we've already talked about in Norris Drive, I bought it for 107, but let's just round it to 100 for easy math.
Yeah.
I didn't know any different. So I put 20% down.
Okay.
Got a loan from my bank, Wells Fargo, where I banked with for 20 odd years. I didn't know any different.
Yeah. Right.
Yeah. I didn't know. Right. And then I realized after doing that one that I could buy more properties and just put 10% down. So I did that for the next 2. But what people need to realize is we started this business that was it. That's all the money we had. We had $40,000, right? So we didn't have this huge stake in it. So after buying 3 properties, right, 20K on the first, 10K on the second, 10K on the third, roughly, we were out, we were done. But what happened is we were investing over time. And if you remember the market, right, we started in 2003. It was accelerating, right? Pre-crash. Now I just got to remember where I am in the timeline. And what I did is I did some cash out refis, like year 4, year 5, year 6. And I took my money back and then bought more stuff. So that same 3 houses became 6 with no new capital, right? We just borrowed money back that we had down because they appreciated. So that's how we got there. Then we actually ended up getting to 8 units or 7 properties, 6 houses in a duplex, something like that. And then it was 2008. We were trying to buy our 9th one. And for whatever reason, we couldn't. And if we just go back to that first house bought for 100, it was suddenly worth 260 grand, right? Because this is how nutty prices got.
This is in Fresno, right?
This is in Fresno, yeah. So, and it's still rented for 1,100. I mean, it doesn't, right? It makes sense at 100. It doesn't make sense at 260.
Sure.
So I went to a real estate meetup, which you should do. You should network. You should get around positive people. You should do all those things. And one of the people there just casually mentioned small apartment units. He called them commercial. And again, I'm an idiot at this point, right? I'm like, I don't want an office building or a retail space, right? I'm not, a billionaire. I don't want those things. He's like patting me on the shoulder. He's like, no, let me tell you. There's 5 to 20 unit buildings. They're called commercial because of financing. I'm like, my whole world opened up. Where this goes is to scale. We took those first 7 or 8 properties we had and we did a 1031 exchange. We exchanged all of them. We went from 8 doors to 80 doors in about a year and a half.
Oh my goodness.
No new capital, no new nothing. And then obviously what happens is the market rolls over. We look like geniuses because we timed the market. We took all this fake equity because that 260 house we sold and we bought for 100 went all the way down to 75 grand. Right? So it didn't hit us because we had moved all our equity to a building. But this is how crazy it was. So that house we sold for 260, part of the equity we took, we put into a 5-unit building that we bought for 220. So we sold for 260, bought for 220, but the rent was 1,100 and 3,000, right? So figure that out, right? So if some is good, more is better. And we went from having, hundreds of dollars in cash flow to thousands just via the 1031 exchange. The IRS was our friend because there was no tax hit and, life was good. Then the market falls out. Yeah. And, so then we got to change. And again, we didn't know this at the time, but we go to a bank, right? We're now looking to buy assets for about half price because, we're buying as it goes down because we don't know where the bottom is. But they basically tell us to pound sand because we're the reason the economy's crashing. All real estate investors are greedy and stupid and, all those things. But our stuff cash flows. We weren't hurt by the downturn. We didn't get it, but the banks were the banks, right? They had the rules and the cash. So we had to figure it out. So we ended up, continue to save money this whole time because we were, it all starts with saving money, living below your means. But then we started doing what now is grown into the BRRRR strategy. It wasn't called that when we did it, but we would buy stuff for cash, fix it up, then go refi it later and pull out all our money out every time. And we kept going and going and going. And we did that over and over and over. I wrote about this and talked about it with Brandon Turner and Josh Dorkin on Bigger Pockets, presented at their event in like 2008 or 9. Again, I didn't call it BRRRR, but that's what we were talking about in my session. And, lo and behold, they took it and ran with it. So it was fun.
Okay. So basically you started the traditional route. It sounds like it was a little slow in the beginning.
Yep.
Then once you took you took those properties and you 1031 them. Mm-hmm. Did you take all those gains and then just put it into those buildings cash, or were those gains the down payment to get the commercial loans to then own the bigger multi?
Yeah, they were all bigger, right? You had to up level. We still had debt, but the debt was like 40 or 50% LTV.
Oh, wow.
Right?
Okay.
Right. So they cash flowed like, we went from hundreds of dollars to thousands of dollars because of the 1031 and the inflated prices in houses. Yeah.
That's amazing. And this is and the only area you've done this is Fresno, California. You've not Midwest or anything.
No Midwest, all Fresno. And the other thing that people should hear is I did this all out of the MLS, the multiple listing service. Think realtor.com, Redfin. Wow. I didn't have a wholesaler. Wholesaling wasn't a thing when I started, man. It wasn't there. Flipping was around, but no wholesaling, no bird dogs, no driving for dollars, no postcards, nothing, right? And the reason we were able to do it is I was disciplined. I got up at 6 a.m. every day for 10 years, and looked. And again, I didn't have an agent. I was just looking at a public website. And, we found every deal we had before I retired, except 2, were out of the multiple listing service. So people that say you can't buy deals out of the MLS are just wrong. I retired because of it. So
yeah, it's amazing. So that myth is officially debunked on the Pave the Way podcast as of this publication.
There you go. I like it.
I see people all the time, especially in like Vegas. Like I got a buddy in Las Vegas, and he still buys a ton of deals on the MLS. He does like 15 deals a month.
More than half my deals are out of the MLS this year. I've done 8. I think 5 of them are MLS deals.
It's amazing. It's amazing. And it's amazing. Once you have your criteria set and what you're looking for, then you have those blinders on. And all you got to do is just try to match to what you want to find. I think a lot of people are like, oh, there's no deals. It's crowded. Well, they're making excuses. And if that's their attitude, it doesn't matter what they're doing to get deals. They're not going to be successful.
Well said.
Absolutely. I agree. So let's kind of get into, I like how there's a guy, I'm not sure if you heard of him. His name is Paul Morris. He's a very successful real estate guy. He's got like 600 units. He owns a bunch of franchises. He's got 3 rules for being successful in real estate investing, and it's buy where you know, buy value add, and make sure it cash flows. And it sounds to me like you have done all 3 of those things for the last 16 years.
Yeah. In fairness to those rules, I did not know Fresno at all before we bought the first one. I knew nothing. I'd never been there. I didn't even know where it was, right? I just did a map. I put, a compass because, the rule back in 2003 was buy 30 minutes from home. That's what every author wrote about. Yeah. I live in Mountain View, which is just ridiculously expensive, even back in 2003. And it just didn't make sense. So we wasted a year looking every weekend, every Sunday for that magic street in our Bay Area that would work. Doesn't exist. No. Still doesn't exist. And then we just pulled out a map and we started drawing circles. And Fresno is the first market of size. It's actually the 5th largest city in California and the largest city not on the coast.
Really?
Yeah, it's bigger than Sacramento. Yep.
Wow.
So yeah, that's legit. That excited me. It survived the .com crash just fine. And, we've been there ever since. We did, back in the peak, just because we had to, we did look at other markets like Texas and Vegas and others, but to your 3 rules, we knew the market. By then we had a team. We knew value add and we knew what cash flowed. And why change? We don't need complication like we talked about earlier.
That's it. Keep it simple. So that brings my next question up. With a portfolio the size of yours right now, what are you doing to manage these properties? Because that's a lot. There's a lot of stuff going on. I'm glad you asked me that question. I
am glad you asked that because you got to remember my situation, right? So when we started this 30 years, Fresno's 2.5 hours away one way. I had a job that worked 60 hours a week before travel. I traveled over 100,000 miles on airplanes every year, 100 nights in hotels. So I didn't have time. So I've had a property manager since day one. So I pay someone else to deal with that. My job is to find deals and secure capital. I gladly outsource everything else. Now, it takes a while to find a good property manager. I fired the first 5. You got to get processes and procedures, checks and balances. But frankly, my freedom now is mine. I still look for deals. I still, coach and try to help people. But yeah, you couldn't pay me to property manage. It's the worst job on the planet. It's terrible.
You're not the first person I've heard that from.
Yeah, it's terrible. You couldn't pay me.
Yeah, absolutely. So here's something, because I'm sure a lot of people right now are like, I totally agree with what Michael said there. What is a reasonable fee to pay a property manager? So you're getting good quality service, but you're not getting ripped off, or not, you're not, getting you're getting good service, but you're not, going to the cheap guy and now he's what's a good property management fee?
It's 8 to 10%
of the gross rents.
Of gross rents, yeah, correct. Okay. Somewhere in there.
Bill you that on a monthly basis or a quarterly basis?
Sure. I like monthly. I mean, that's how I pay my bills.
Okay. And then what are some things that people should expect? Like if they want to hire a property manager, what are like the 1 or 2 things that they just need to look out for, especially when they're doing it from a sort of a distance, because you're 2 hours away, which is not.
Yeah. Yeah. You can get a lot of places in 2.5 hours. So, I'm in Fresno, but you can get to Phoenix and Vegas, in 2.5 hours, no problem. With the number 1 rule that I learned after firing 5 property managers, which are terribly hard, is I always want to know more about the principal, the owner. I want to know where their income comes from. So a lot of the ones we had in the beginning were agents or brokers.
That's interesting.
So what happens is, they might give you the love and attention, but when the market gets really, really hot, their focus is going to go on their earning commission. They're going to ignore property management. Or if they're lenders and it gets really, really hot, they're going to ignore property management. Lots of people have a property management side business because it kind of keeps running the bills. But when you look at their tax return, essentially, where they really make their money. So I want an investor. I want the owner of the company to own rentals, and I would prefer them to own, more than 10, right? I don't want them to go, oh yeah, I have a rental. It was my mom's house, and when she died, I turned it into a rental. Well, you didn't buy it. You don't know what the 1% rule is. You don't know, you don't know anything, right? I want the owner of the company to be an investor so that when he or she sets up the procedures, they are set up by somebody who is an investor, not a real estate agent, not a lender. That's the number one thing for me.
That is awesome. That's such good advice right there. And that's something that I mean, a lot of people are, unfortunately, I'm sure you've learned that the hard way. It's all about where are your interests? How are your interests aligned? Are you thinking on this, on the same direction? Are you not just kind of going all over the place? That's fantastic advice for someone who, especially looking to hire a property manager. What are the, where are the owners getting their money from these rental properties, or are they just making fees up the wazoo and they have no portfolio? And then they could care less, because exactly. They don't know what it's like. They're like, whatever, I'm going to get my 10% and I'm going to drink my martinis and drive my fancy car back home and then not deal with the problems that are in our eyes.
Yeah. They're not going to grind on the tenants and bill back when it was really tenant damage. And they're like, no, you're the landlord. I hate it when people assume because you're a landlord, you're the rich person. I'm like, well, how the frick does that matter? I got a mortgage to pay and all that. Why does that? Why do you have that attitude? No, bill the tenant back. They broke the window. Yeah, I'll fix it now so it's secure. But, bill them the $90 for the new glass. Why am I paying for that?
Yeah, right. I totally agree with you. Man. That's great. So I'll shift to one more rental question. And I want to talk about kind of your book and some of the things you talk about in your book and how listeners can get a copy of that book. So when it comes to like your criteria, right? Because you obviously you got started with one rental and you have the book One Rental at a Time. But when you're looking at a deal, right? Or if any investor's looking for a deal, there's a few ways you can really acquire these rentals. But what is something that you're looking for, maybe 3 things that need to check the boxes in order for you to make an intelligent offer on that deal?
Yeah. So I'll answer kind of across the board, right? So if I was a busy professional like I was in 2005, let's answer that question, right?
Yeah.
So I had a crazy day job. I had a good W-2. I was definitely in the, this is my side hustle, right? I want to add 1 or 2 a year, but my job is to be very, very good at my day job, right?
Sure.
So what I want to do there is I would want to buy, a cash flow asset that produced somewhere between 5 and 8% cash on cash, or what I call yield. And just so we're clear, that means down payment, closing cost, and any make ready, right? That's the denominator. And then the numerator is expected yearly cash flow. Do that math and make sure the result's somewhere between 5 and 8%. Yes, you can earn more. Yes, you can do those other things in other markets. I have found that those other areas have other problems, and Excel lies, frankly. I think Excel, when people say
it does lie, I know that for a fact.
I'm going to get 12% in Cleveland or something. I'm like, you're not. Yeah, you might get 12% for 6 months, then they're going to leave and you're going to have a turn. And it's just sad, right? I have 15 years of history. I've done blended numbers across all of that, and it's just not possible. So I want a turnkey solution, 5 to 6 or 7% yield, so that I can and I'm going to put more down, right? I'm going to put 30% down because, again, my job is to add 1 or 2 a year and keep crushing at my day job so that over time, tenants pay off my assets, which is awesome. Cash flow goes up because of inflation, and I'm sitting pretty in 10 years. So that's if I'm busy, that's what I want.
If you're busy, and that's a cash on cash return. So that's a return on the equity that you have in the deal, right? That's not just
the cash invested. Yes.
Okay.
Not technically equity, because equity you could go, well, I bought it at a discount. Forget all that, right? That's
yeah.
I don't count appreciation in any of my calculations because I think it's a fake number that, you could say it's 17 grand and I could say it's negative 20. I mean, who's going to, whatever.
Yeah. That's funny.
So today though, I'm still buying today. That's another thing people need to realize. I probably added 20 or so units this year, but today I'm being a little more selective. I'm actually only doing owner finance deals, right? So I'm finding landlords that are probably over 60. They probably own the property over 30 years. So they depreciate it to 0. And a lot of them think the only way they get away from the tax hit of a sale is to die, right? Because then they pass it on to their heirs get stepped up basis, right? They don't get hit. What I do now is I go to them, I say, well, if you want to stop the daily headaches of being a landlord, let's do an installment loan. Maybe, we'll work out a price. I'll give you 5 or 10% down, so you have some cash. We'll work on interest rates. And, I just picked up 15 units from a seller. He was done. He wanted to go live on a cruise ship the rest of his life. So we worked out a deal. He sold me a portfolio that I'll keep till I'm that age, but I got it for $500,000 less than it's worth. He's getting the amount of money that he wants every month. And we have a fully amortized loan that'll be paid off in 20 years. So it was negotiated from a win-win position, and he's got protection. So I can't just flip it or something. When you really want to add units and you come at it from a win-win perspective, there are sellers that really could benefit from an installment loan or what's called owner or seller financing. So those are what I'm doing today to add to my portfolio.
That's a huge nugget for everyone, especially the way that you got so specific in the criteria. People who've depreciated their property, who are older, who might not want to be a landlord anymore. You're adding a lot of value to that guy because he's an income stream every month, and you're getting the cash flow every month. It's a win-win, right?
Oh, and think about the tax hit he avoids.
Oh, right? Yeah.
Let's just say it was $1 million for easy math, right? Well, that $1 million is going to be taxed like capital gains. So he's going to write a $150,000 check to the IRS.
Yeah.
Because it's depreciated to zero, right?
Yeah.
It's a great help. You can, let's just use $1 million. I may give him $100,000 as a down payment and give him $5,000 a month for this. It's just different taxes, right? You're keeping them below different levels, and it's definitely win-win.
Absolutely. And is that loan, and I like how we're just kind of getting granular on this deal here. Yeah. Is that a loan on the schedule to be 20 years out, or are you going to have to balloon him out in 5 years?
Fully amortized 20 years, 5.05%.
Wow. That's awesome. That is awesome. That is great.
It's all negotiable. You can negotiate price, term, rate, what's down. He's the bank. Yeah. He's the bank. Yep.
That's awesome.
Or he or she, let's not be sexist. He or she is the bank.
Yeah. Right. Awesome. Well, great. So Michael, as we kind of conclude the show here, I mean, we just gave everyone a crash course on how to buy rental properties, no matter where you're at. If you have to leave the listeners one more kind of tip on maybe getting from where they are to where they want to be, let's just make this rental related, because that's what we've been talking about for the last half hour. What would that one piece of advice be, just to cut through all the clutter? And because there's so much stuff out there now, like if they could do one thing that's actionable from today's show, what would that one thing be to get?
It's funny.
Moving in the right direction.
Yeah. I just did a video on my YouTube channel called 5 Uncomfortable Truths About Real Estate Investing.
I love it.
So I think we can talk about them because they're all real, and one or two of these will hit you right between the eyes. So here's number one. The first uncomfortable truth is you need to live on less. You need to understand what is a need versus a want. And you need to sacrifice, and that's the only reason we were able to retire. We write about it in the book. We started living on less than 50% of our income, where up until I was 30, we were spending as much that came in. You have to live on less because you need to build a pile so you can go buy assets that others pay for. So people need to, I know it's not sexy. I know it doesn't look good on Instagram and Facebook, but you need to understand and stop buying stupid things. Right? So you need to live on less. That's the first uncomfortable truth. Another uncomfortable truth is your network matters. And it is amazing when I get to around people and I start talking about real estate investing, if they don't really know my story, some people still tell me being a landlord's risky, right? And these people don't own any rentals, but they're here telling me that being a landlord is risky and you can't do that and nobody's done it. And I'm like, clearly we're on, just some people are negative, right? And unfortunately, sometimes it's family members, right? If you have somebody around you that's a battery drainer, that's just making it difficult for you to be positive and move forward, spend less time with them and then go network, right? Go get around, go to a real estate meetup. And the energy at every meetup I've ever been to is it's like lightning in a bottle. Even if you don't like the people that are speaking, just the network of other investors, you're going to feel better leaving than when you got there. So your network matters, both for up and for down.
Love that.
And then another one that should be really important is everybody can do it. I've interviewed people that don't have high school degrees. I've interviewed people that have started in their 50s. I've interviewed felons, like 2-strike felons that are successful at this. It doesn't matter your sex, your age, your race, your religion. Real estate doesn't know you, right? It's it's a, you know, it's a physical asset. So anybody can do it. So don't think you can't for some reason, or you're some story or some baggage. So those are 3 of the 5. I can't remember the other 2 off the top of my head, but those are 3 things to think about.
That's great advice. I think that is super, super insightful and very helpful for people listening. I think people are going to really resonate a lot to this interview because we've really covered so much in such a short period of time, and it's a very actionable show. So Michael, I know you wrote a book, One Rental at a Time. It's on Amazon. So let's talk a little bit about that, kind of what that book is about. And then, you know, obviously they can get it on Amazon, and then we'll wrap up with any contact information from you. So if people want to, you know, find out more about what you got going on, they can maybe reach out to you. So let's talk a little bit real quick.
Yeah. So the book, you know, yeah, I never thought I would write a book because I was a C student. I quickly learned growing up that if I got a D, I got beat. And if I got a C, I didn't get beat. So guess what? I got lots of C's.
C's.
I was, yeah, okay. C's, no beatings, D's, beatings. Got it. Check. Understood. So I wasn't a great student, especially English. I mean, if you ever get a long email from me, it's going to have misspelled words and all kinds of stuff. Yeah. So I never thought I would write a book. But so I leave the rat race at 45, February 1st of 18, and something's gnawing at me. And what was gnawing at me is I remember back in 2003 going to an actual physical bookstore before Amazon was around. And I looked at all the real estate books, right? And as I thought about it, all the real estate books were written by a guru or an agent or somebody trying to sell something. And I'm here sitting going, I don't remember a book written by someone who was me, right? I was a 60-hour-a-week tech worker, traveled all around the world, was willing to sacrifice and do one rental at a time. And man, after 15 years, it worked. And I remember the desperation the first year and the second year and just going, oh my God, we've got 8, but we can't buy anymore. The market's over. So I just felt like I had to document the story because I think, and I wrote it for a way so the book could be valuable in 100 years because market cycles are real. They change all the time. And I just wanted that busy professional. I wrote it for my younger self.
I love it.
Yeah. If my busy self found that book, it should speak to me. Now it's not a how-to book. It's not one of those. I'm not trying to do anything. I'm just telling you the exact story we went through over 15 years from a single house to 175 in financial freedom. I give you a couple of, 22 bits of advice at the end, but it's really that story. And it tells us the good and the bad. And I'm glad I did it because it felt good getting that out.
I love that. I'm sure a lot of people are going to want to check that book out. So if they want to check it out, they can go on Amazon and type in One Rental at a Time, Michael Zuber, and they could get their hands on that book. And I'm looking forward to reading it myself. It's actually on its way as we speak. So
nice.
Michael, if people want to get in touch with you, if they love what you had to say today and they want to reach out to you, what would be the best way for people to get in touch with you?
Yeah. So the best way to get in touch with me is to be a subscriber on my YouTube channel. So just youtube.com/one rental at a time. When you're a subscriber, you can just, leave comments. I'm the only person that sees it. I'm a one-man show. I actually have something called subscriber questions. So when somebody asks the questions, I create a video. I do daily content. If you would like my email, it's actually in the book. It's mzuber. So M is for Michael, mzuber at onerentalatatime.com. But yeah, I think the best way to really figure out what I'm doing, I give everything away for free, youtube.com/one rental at a time.
Awesome. Well, I'll put all that in the show notes, Michael. This was a very good episode. I'm very happy we did this, and I think people are going to get a lot of value from today's episode. So thank you so much for being a guest on the show. It was nice meeting you, and we'll talk soon.
All right, buddy. Take care.
Awesome.